Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 28. As you can probably see, I am doing this on the road again, live in actually my car now, back in Edmonton. And, honestly, today I want to quickly chat about self-management versus why most of us prefer to actually have property management built into our deal analysis and actually working with property management companies. Because I understand, when you're first starting out, that line item can seem so daunting because again, they're taking anywhere between 5 to maybe even 15% away of your bottom line. And so for a lot of people, when you're first starting out, especially if you're not trained properly, you're just collecting properties, it's really difficult to justify that simply because of the fact that property management can eat away effectively your entire cash flow, if not more. And I think over the previous episodes throughout the entire season, I've been sharing this with everyone. There are only 4 properties that I still self-manage to this day. And the funny thing is, as of the end of this month, that 4 will be down to 2. And I want to share a little bit about the thought process behind why I still have 4 properties that I've been self-managing. And honestly, it's not just me. It's between me and Ray, the two of us. We have 4 properties here in Edmonton because first of all, this is where we live. And second of all, the 4 properties, this is actually how it started. 2 out of the 4 were our very first properties under our personal name. Again, that is not how we do things anymore because these properties were actually acquired before we were professionally and educated about how to do income and asset protection. On a side note, this Saturday, we are doing a coffee chat on how to maximize income and asset protection as professional real estate investors. So that coffee chat is free to attend and it's happening at 11 a.m. Eastern time. So 9 a.m. Mountain time, 8 a.m. Pacific time. I will share the link in the comment section below in a little bit so that you can get yourself registered. And we're going to have a panel discussion in terms of how we actually structure that. Now, coming back here though, like I said, 2 out of the 4 properties that we still self-manage were simply because of the fact that these were our first properties under our personal names. And in a way, because I always joke about the fact that if you actually gave me a hammer, it is more of a weapon than a tool. So what that typically means is that when we buy properties under our personal names, these are usually the properties that are very, new and turnkey, if you will. And so that means that the need for maintenance is a lot lower. Obviously, we have professional inspection done by a licensed inspector. And so that we know that in terms of a line item, once again, everything goes back to the spreadsheet because as educated investors, we are always constantly stress testing our own deal before we even get into it. And so in that case, what that really means is that we like to buy newer properties, and ideally and theoretically speaking and statistically speaking, these usually have way less issues in the short term. And again, by short term, I mean 2 to 5 years. And so that being said, we'll put those 2 aside. The other 2 that we continue to hang on to and self-manage are the ones that, honestly though, through our raising funds journey, and we just got off of a train of raising funds episodes as well, we've come across investors that literally just told us that we are ready to jump in. However, we would like you to personally manage these properties. And sometimes that's where it starts. And a lot of the times, really, we will say no these days. However, with these 2 properties in particular, and I will share with you one especially because that's the property that I'm actually driving to right now. Literally had to pull over to the side of the road to do this episode because the traffic was a lot worse than I'd expected. I was really hoping to do actually a property tour with everybody because what happened with this property is that back in 2019, this was fall 2019 now, we decided to do 3 different flips. And so we also just came out of a flip episode, a couple of flip episodes as well, alongside with the raising funds episode. However, the idea behind this was that we knew that there were some major expenses coming up, and for us, this was launching Trust Your Talent Academy. And so we decided to do 3 different flips just to do some quick cash injections. And so 2 out of the 3 properties successfully sold before COVID lockdown started happening in March 2020. And so this is why, again, controlling the time frame, it is so important. At this point, what really the fail point for us was that we had 3 different projects. And the funny thing is, even though lockdowns did not start happening until March 2020, many of us, if you actually remember, COVID was actually already around, and it started out in Asia a little bit more. What that also means is that the whole supply chain issue actually started way before COVID lockdowns started happening here in North America. And so we had some supply issues. So we completed 2 projects, got them listed, got them sold. And the third one, we were waiting for a few parts in particular because we were flipping the property. And that's the other thing too. We can have a discussion about that if that's, one of the questions that you have. So make sure you comment or DM me if that is it. A lot of the times when we are doing a flip project, we tend to choose better materials. And when we're choosing to do a BRRRR and hang on to them as income properties, we tend to choose more durable materials. Those 2 things are not the same, okay? Those 2 things are not the same. And these are the skills that and the experiences that you definitely will gradually pick up, as I had to. Like I said, I am not handy whatsoever. However, those 2 things are not the same. A lot of the times people tend to think that the more durable materials are more expensive. Not necessarily, okay? So the point is, when we are doing flip projects, we tend to choose pricier materials, and just because we want the end product to appeal to a certain target demographic. And so with that said, this particular property did not get sold on time, and then COVID lockdown started happening. And then what happened was that we, obviously, as I mentioned, 3 by 3 strategies in 3 different markets to give you the maximum protection of any deal that you want to go into. And so in this particular case, even though we knew we were going to flip it already, we knew that hanging onto it as an income property, which means it will turn into a BRRRR automatically, the BRRRR process, and hanging onto it as an income property, basically was our other immediate exit. And the last exit strategy that we have identified for this particular property in this particular neighborhood is actually serviced accommodation. And so on that note, what that really means is that after all is said and done, we decided that we were going to keep it as an income property because the fair market rent on a long-term rental is actually performing pretty well, so that we wouldn't have to go through an additional expense to set it up as serviced accommodation at first, because that fundamentally changes the number in terms of cash on cash return after we've basically pulled our equity out. And so on a side note, on this property, we actually managed to pull every single dollar out. And I'll give you a quick run through of the numbers too, because this was actually one of those properties where I was not even in town myself. And as I mentioned, I really, really love working with good power team members. And in this particular case, we have a very, very solid realtor that I've been working with for the last, how many years now? 8 or 9 years at this point. And so I was actually away on a conference, and then I got a text. And that's the thing. We've built a relationships to the point where our realtors, when they send us a deal, all I need to do is get the money ready. That's how well trained that we both have gotten with each other. And so with this particular property, when the deal was presented to me, it was literally, hey, Tim, you know what? Here's a property. This is the situation. The seller is a motivated seller because he's in his 80s. He's moving into a home, and his son's actually helping with the sale. ARV, after repair value or fair market value, once you've actually done the proper renovation to it, is roughly around $320,000 to $350,000, depending on the quality of the renovation. And right now we're able to pick it up for $200,000. The reason why it was so cheap, A, because they were motivated to sell. However, B, mostly because they understand that they have actually not done a single upgrade in that property since the 70s. So this is a 70s style bungalow right here in Edmonton. So most of you, if you've been in this market, you understand that these properties are everywhere these days. And a lot of the investors coming from outside of the provinces, if they want to start small, these are the type of properties that they will pick up, because then they would actually suite it, turn it into 2 units. However, I decided to keep it as a 1 unit simply because of the fact that this was supposed to be a flip. And so after all is said and done, basically we put in $60,000 worth of reno. So now we're $260,000 in, plus some holding and transaction costs. We were about $275,000 in. And then because we did not sell it and I decided to keep it as a long-term rental, what happened was we got an appraisal, did a refinance, and it was appraised at $335,000, 80% loan to value. So we were basically able to pull out every last penny that we put into it. And so on that note though, at this point, because I was also traveling a lot, many of you know that I travel 6 to 7 months out of the year, because that's the lifestyle that I've worked really hard for as an investor to build over the first decade of my career. And so at this point, I actually decided to hire a screening agency. So there are people that are out there, they're not professional, or I shouldn't say not professional, they're not licensed property management companies. However, because they have been in their investing game, screening tenants themselves for a long time, they actually offer their services as tenant screening company only. They don't manage it for you. However, they will screen them based on the criteria. And so clearly I did align with their process. They would do criminal checks, they would do credit checks, they would do reference checks, and they would actually look into bank account statements, asking for employment statuses and confirmation as such, so that we are able to really trust that the people that they're bringing in are decent people. Okay. And so in this particular case, the funny thing is, these tenants, and that's the thing, you know, we can do as much due diligence as we can. However, things don't always go as planned, and sometimes what appears great on paper may not be the case. You just got to learn to roll with the punches, and that's in a way where growth happens. Long story short, these are actually what I would call very solid B tenants, because they pay the rent on time. However, the part that they, in my opinion, are B tenants and not A tenants are because of the fact that they're quite rough on the property. They're quite rough on the property. Every time we do a walkthrough, you know, it's very noticeable that there are a lot of damages around the properties. And we always let them know. And here's a side note. I feel like this is turning into more of a property management episode almost. However, you will always want to document everything. Take pictures, because clearly in the beginning when you're doing the walkthrough, the move-in walkthrough, you will have pictures and videos these days. It's a lot easier now compared to 10, 13 years ago when I first started in this career, on this journey. So these days, everybody's pretty much got a smartphone. We can document a lot more things. And so with that said, every time you do an inspection, and obviously in this particular case, I would do more walkthroughs once every quarter instead of once every 6 months or 12 months, because you can already see from the first visit that they're pretty rough with the property. And so by rough, I mean, you notice a lot more dings, a lot more smudges, a lot more dents in the house, a lot more broken light bulbs and switches and handles, and doors may be falling, cabinet doors are maybe falling off. There might be more scratches on the floor and walls, just little things like that you pick up. And again, don't ever be lazy about it. After you do the walkthrough, you have to make sure that you send them a summary email pointing out every single deficiency that you have picked up. Really very similar to an inspection report that we normally would get, that we pay for, okay? And so, again, in this particular case, I mean, we know that they're fairly rough on the property. And so as of today, they've been in that property for nearly 3 years now. Okay. And so at this point, they are actually moving out. So this is actually a move out visit that I am going to. And I will actually share more of that story with you in tomorrow's episode. Okay. However, I want to really go back to self-managed versus professional management. And the reason why this was kept as a self-managed property, because that's really how I started the episode, is simply because of the fact that in the beginning, when we decided to go through the flip process, I leveraged private money. So this was, like I said, raising funds. We just came out of a few raising funds episode. 100% of the purchase as well as the renovation. So $275,000, as I mentioned, it was all borrowed on private money. Okay, it was all borrowed on private money. And so when I decided to keep it as IP, I bought out the cash investor and I substituted with another investor's qualification because I happen to have an investor waiting in the queue. And again, over time, and so many people, when they first hear about this, if they're brand new, never actually done a deal yet, they don't really understand this or even believe it. However, we always say that every educated investor will get to the point where there's more money than deals. And that has been the case for us for basically a decade now at this point. There's always more money than deals for me because I have a queue of people that have been waiting for good deals because we've done deals before, or they're brand new and they're waiting for something good to jump in on. Or when I say something good, it also means that I'm actually pairing them. If you refer back to yesterday's episode, basically we are the middle people. Okay, we are the people that are finding money and finding great deals and marrying them. And that's where our service, our knowledge, and this entire support and the network that we have really come into play. And so in this particular case, I basically found another investor, and I've identified that this is a great opportunity because it's a very low entry level, first of all. Second of all, it's a long-term hold. And third of all, their money is parked against hard asset. And last but not least, their qualification power is exactly what I was looking for to buy out this property so that the previous investor can actually cash out. And so this particular investor that did this basically said, okay, I would only do it if you self-manage, given that this is your home market. And so, of course, I said yes, because this year especially, we have a model, even at Trust Your Talent Academy, is do whatever it takes. And that has always been my model because so many people think that success comes easy. I will say no. And I still believe the true definition of luck is when preparation meets opportunity. And so these days, as great as life is, as free as I am, I will still push myself to do things that I probably normally wouldn't do anymore once in a while, just so that I can stay sharp and continue to challenge myself. And so in this particular case, I had an investor coming in, and this turned out to be a 2-year deal. They held a mortgage for 2 years, which was awesome because what ended up happening was that these investors, they gained enough confidence during our 2 years of working together. And after 2 years, I was able to also qualify myself to buy them out because we initially did a 2-year term. And now they are actively in our larger deals and longer term deals, as well as some smaller lending opportunities too. And this is what I mean. And sometimes as professional investors, what we got to do is that we are the people that have to really pave the way for these new investors to get comfortable working with us. And so, yes, money's waiting. However, there are still a few things that we need to do to really satisfy that money, because I don't really believe in transactional relationships anymore these days, especially if you're in it to play the long game. And I hope that many of you that are watching are in it for the long game, because real estate is amazing. You can make short-term profit and you can also grow long-term wealth all at the same time. And so in this particular case, I was able to leverage our own qualification last year to buy out the property. And so at this point, the tenant is actually moving out, and this property is going to be listed for sale. However, there are a few more details in between that I'm excited to share now with everybody tomorrow. So on that note, I just want to share a little bit about why I still self-manage. However, for the most part, everything everything is managed by property management companies now, because I did not get into this in the long term to look for another job. And I hope that's the case for you as well. In the beginning, I understand that this is something that you want to do, or like myself, once in a while, you will still take on self-management simply as an induction process when you are working with a brand new OPM. So hopefully you've got some nuggets out of this and you found this valuable. And if you enjoy my Daily Dose with Tim, make sure you like it, follow me, and stick with me, and share this with anybody that you think can benefit from it. And I really appreciate all the encouragement and the comments and the DMs especially that have come my way so far. I cannot believe that it is already episode 28 for season 3 already. So I know some of you have been asking for where season 1 and season 2 are. They're actually hosted on YouTube now under the Trust Your Talent Academy channel. So I will share those links in the comment section once I am done my property visit here today. And I look forward to sharing more story about this particular property as promised tomorrow with you in the next episode. On that note, thank you so much and have a great rest of the day. Live well, everybody.